Welcome to Trading Edge, the Trader's Edge. I'm Jim Iuorio. That's Bobby Iaccino. Please also join us along with our technical analyst, Mike Arnold, at unfilteredinvestor.com. You will not be sorry. Bobby, I heard there was a meeting at some ski resort. What's happening today? Where is it about?
I love when you do that, brother. Yeah, I got the quote right in front of me. I was watching the live markets on this screen while I was watching Trump on that screen up there. And as soon as he said, I don't have to use force. I don't want to use force. I could use force, but I won't use force.
Can you do it in your Trump voice? Come on, you do a good Trump voice.
All right, let me get the microphone close because he always has it close. Hang on.
People, hold it. Let me just set you up here. People, tune in quickly. This is going to be worth it. Go.
I don't have to use force. I could use force. I don't want to use force. I could use force, but I won't use force. I could if I wanted, but I won't. When he said that, I saw the VIX drop 1.5, 2 points immediately. And I saw equities. The equity futures were still playing. It was 5 minutes before the cash opened when he said that.
Right.
And the equity futures just went from the futures were fun to watch this morning because they were slightly positive, then slightly negative, then Trump spoke, and they went slightly positive on the way up to pretty positive by the end of the day, right?
Yeah.
Last I looked, the S&P was up, I think about 1.5%, somewhere in that range. That's the futures. That's what I traded. And the first thing I did was buy Russell, and texted a friend of mine, I'm buying Russell on this. And he's texted back, buy all the Russells. So I didn't buy all the Russells. But I went right into small caps.
Right. Okay. As long as we're talking markets, we do have, and you know how Bobby and I have an affinity for anonymous Twitter accounts if we can verify that they actually know what they're talking about. Guys like Doomberg, Rudy Haverstein, and our friend Markets Mayhem. Let's bring him on. Above you on this. Mayhem, how are you?
What's up, guys? Pleasure to be back.
Hey, Bobby, I'm looking to retweet the live feed on your Twitter page. I don't see it. Luis, did you put it out yet already on Bobby's?
Let's see. I hit it. Yeah, I'm live now. It's there.
Oh, there it is. Markets and Mayhem. Okay.
Yeah.
Again, we are comfortable enough that we can just talk about housekeeping when we go live. Bobby, you go.
Well, what I was going to say right off the bat was, the trade today that I was talking about, and I want to get your comments on this, Mayhem. Before I do, though, one of our regular viewers, Widge, right after you put up that you were going to be the guest, he reposted. He said this was an excellent guest the last time, very clear and concise in his thoughts. So I thought I'd mention that right off the bat.
Appreciate
that's what
that.
somebody was expecting from you. So let's see if that keeps going. I'll tell you why I bought Russell, Jimmy. I bought Russell because I thought the military threat was gone, which I never believed was real anyway, but the tariffs threat still existed. So I said, okay, what's good here? Domestic. Now, it's not to say that the other three weren't going to go up. They did. But with the military threat gone, the tariff threat to me becomes 5% more real, 10% more real. And so I said, okay, I want to buy stocks here. And as I'm looking at the futures right now, the Russell's up almost 2%. The other ones are up between 1.1 and 1.3. So it was the right trade for today. Whether it's going to stay the right trade, I don't know.
So how long are you going to keep it on for as your intent?
This is probably a little bit more of a position until I see what happens with this kind of stuff. I've already got just a slightly below break-even stop in place. But, I think we're going to drive to new highs here. I think GDP is still going to come out at that pretty robust 4.8% that is expected. So I don't see a reason to get out of that trade any more than I see a reason to dump all my gold longs yet.
Makes sense. Okay, so Mayhem, you can either elaborate on what Bobby said about small caps and how those particular quotes affected him, or what else did you hear at Davos that you thought was interesting from a market standpoint?
I don't know if it all came from Davos, but it was certainly circulating the headlines. I'd love to touch on the Russell thing, but first I heard it was an official from Denmark essentially telling President Trump to F off
Yeah.
And then maybe an hour or two later, we sort of got a bit of we've got a concept of a plan of something that might eventually come to fruition. And markets love that because it meant the immediate threat was coming off. My contention yesterday during my live stream in the morning was that cooler heads would prevail. We've seen this playbook before. And indeed, that's what's playing out. And Bobby, I love your trade in the Russell because I'm of the same mind. In fact, we've been bullish of the Russell for some time because we think, A, it loves rate cutting cycles. You're taking down the risk-free rate. That increases speculative appetite. You're also reducing the cost of capital for these companies that they can't go out and just issue bonds. They have to really borrow at prevailing rates. So those are very bullish for the Russell. On the other side, you have a bit of rotation into small caps. At least in the S&P 600, valuations are comparably attractive to the larger 500. So I think there's a number of tailwinds here that can keep that story going. And then one last thing, the relative strength between the Russell and the NASDAQ over the last couple months, insane. Suggests there's also more room for this to move.
Okay, so is part of that, was there really positioning such that people were short the Russell, long the NASDAQ for a couple of years? Or is that just me thinking, wanting to see something that the TMZs of financial media don't see as far as market positioning goes? Do you think that some unwind happens too?
Yes, 100%. That is a real thing. You're not imagining it. And basically, it's one of the favorite playbooks of hedge funds. And what they do is, in aggregate, they short a lot of the lower quality stocks. Their favorite macro product to express that trade is the Russell. They also go into some of the individual stocks that can get pretty crowded on the short size that lead to prolific squeezes. But to your point, you've seen a bit of degrossing. You've seen covering of that short book in the Russell, and you've seen some of that long positioning in the Mag 7 and NASDAQ 100 also taken down. And that degrossing has helped the Russell to outperform the NASDAQ and the Russell to run like it has.
Let's read a couple of things I'm looking at right now. Mark Rutte, or Root, agrees with Trump that for the U.S. to protect Greenland and that it is critical for him to protect Greenland, that they should work something out. So you're already getting a little pushback or a little push forward there. I'm also seeing a headline that says, Trump cancels planned EU tariffs due to Greenland. So that kind of backs up what you said, Mayhem, that maybe there's some sort of a format of a deal, of a conversation, of an NDA, of a plan, of a something, where I don't know how realistic it is that the U.S. ends up with Greenland as a territory or a state. But I really liked how Trump and Bessent and Lutnick kind of pushed back at the World Economic Forum because
Lutnick told them they were all full of shit. Lutnick was hero in my view. He was the Kevin Roberts of this year.
I don't know if you guys saw Bessent just completely eviscerating Gavin Newsom.
Loved
economic knowledge. Do you think any of that is a negative for the midterms, man? I mean, this is a market show, but I'm just curious what you think about that.
Well, I mean, first I'll say that Davos is one of those places where they tell everyone to travel less and then they all fly their private jets there. So the level of hypocrisy is off the charts. But in terms of the midterms, the one thing that I think we have to go back to, because we like to look at data to drive opinions, is that the sitting president's party tends to lose the midterms. It's quite rare post-World War II that doesn't happen. And there are things lining up that perhaps make that, you can kind of make the case that that's going to be the thing again, I think, this year. I don't necessarily know that that's going to have that big of an impact because this isn't a president that's, efficating the change that he wants to see through Congress. He's mostly doing it through executive decree. So does it really matter if the Democrats run the House and the Senate if he's doing executive orders for a lot of his prerogative? Probably not.
And that's fascinating to me. But by the way, why? Okay, if he has the House and the Senate, and again, I don't want to make the show about politics, but policy matters to markets, obviously. But he wanted to put things forth like voter ID, like some other things that never come up. Like, does he really have the House and the Senate, or is he afraid that there are people who are against him in those, and he won't get his agenda pushed?
Well, he certainly had pushback on things like Greenland and the tariffs and some of the other areas that he couldn't push through. So that may be a point. There may not be a sort of falling into line that he would have otherwise expected on some of those initiatives.
Okay, Bobby, your question, but then we got to circle back to Japan sometime soon. Could be seeing some sort of problem really happening in real time. But Bobby, what do you got?
Yeah, I want to put up a comment, Luis. from Steven, bunch of numbers, an X, a 9, and a D. So I'm not sure who this is. He's watching on YouTube. It says Trump is not a single-digit VIX president. And looking at the VIX, he's correct.
No,
I mean, it hasn't been in single digits for a long
Can
time.
I add something to that comment real quick before your question? Because I've said, and Bobby knows this for a year, I thought that big bear markets, steep bear markets, and huge corrections stem from a complacency that can happen over a year. With Trump as president, you can't be too complacent. So people have their hedges on, which may paradoxically make the rally in stocks more durable than if it was a president of calm. Mayhem, am I an idiot?
I don't think you're an idiot, but I think you're right. We have to be less complacent. We have to be ready for one headline to change the entire narrative at any given moment. Certainly adds up the cortisol production levels a little bit, right? On the other side of it, though, the amount of options activity and near-dated activity, we're talking about 0 DTEs in the S&P being 60% of volume, for example, I think it's compressed the timeline for when these things play out. If we look at August 2024, we look at April 2025, you have these big vol blowouts, and then everything kind of comes back together much more quickly. So I'd say the other side of this is when things go off the rails, because a lot of the trading is happening in such short time horizons, it tends to be exaggerated, and then for that reason, self-healing in a way. I don't know if that's going to be how it continues, but so far that's been the case. And then November and what just happened recently, kind of miniature episodes of the same thing.
He put a follow-up comment in there. That's why VIX's floating term structure is pretty flat. I'm not sure exactly what you mean by term structure. I mean, we're getting a steepening of the curve right now.
I think he means the VIX term structure.
Okay, fair enough.
Meaning that headline risk is, boosting up the front. Kind of that's what it means, right?
Yeah, I think, I mean, I always considered it in terms of the yield curve, but that's fine. I mean, it's a pretty innocuous term.
Yeah.
I'm looking at what you said though, Jimmy, and I want to attack it from this way. I like what you said. I like the first time you said it. I think people are buying every dip, but cautiously because the dips keep coming, And that's one of the things I've always thought about when you're looking at the people who just believe the markets can't go down, that they buy the dips, but they're more cautious. So you literally end up in a situation over time where people aren't overexposed and you have less of a probability for a major retail crisis. And that's something I think we can't experience. Now, I don't think it's on purpose. Like, I don't think he was sitting in the office with Bessent and let's say crazy shit all the time and keep the VIX above 12. But I think it's working out that way. Is that kind of what you mean?
Yeah, that's definitely what I mean. Yeah, I don't think he means it at all. I just think he can't help himself but throwing out headline bombs. Right?
Luis, put up what Markets and Mayhem just put on there so that Steven can see that. He says it's still steepening overall, though, which I think was the point.
Yeah,
so
I got it. Yeah.
Let's talk about a couple of other things if we could. I'd like to go to the Fed specifically, if you don't mind,
Sure.
Mayhem.
Yeah.
Trump's been very vague about who the Fed chair is going to be, right? Seems like he took Kevin Hassett off the table. Do you have any guesses on this, number one? And number two, do you have any sort of idea with the current volatility we've seen, the steepening of the yield curve? Today, the 30-year bond is the only one that had a higher yield than yesterday during the course of the trading day. Is it a situation where, number one, who do you think it's going to be? And number two, is that person going to actually have to bow to the president when the markets may not be looking or wanting a rate cut?
I think those are great questions. I think those are questions where the market is parsing those tea leaves now as well, which may be one reason we're starting to see a little more volatility in the term structure of the yield curve, but the other also being it's kind of blowing out on the long end across the world. I think odds are for Kevin Warsh. I won't say I'm an enormous fan, but I also will preface that by saying I'm not really a fan of central banks as an institution. So I'm not a big fan of central bankers either. But in terms of your question, it hits a really key area. And that is to say, are we going to lose the facade of independence at the Fed? Because we know they're not really independent. They serve the economic elite. Are they now going to serve the president and his interest in bringing rates down significantly? I think that odds favor that. And I think that if that is the case, that may be a policy mistake that can feed on itself a little bit. I don't really like the idea of rates coming down meaningfully from here because we still have somewhat sticky inflation. We also know it's always undermeasured, doesn't really matter who's in power. And it's also survey driven, which means it's going to be noisy and inaccurate. But what we do know is there's some stickiness there. And what the industrial metals and precious metals are telling us is really the inflation story may not be over yet. So if you continue to add more cheaper capital and liquidity to a financial system that's already seeing this big rotation into hard assets, I think that is a rotation that would continue. So for folks that are looking for how do we make money in this environment of increasing uncertainty and increasing fiscal and monetary irresponsibility, I still think the precious metals can be a performer in this environment. I'd love to see silver cool off a little bit. I think that run has been getting very extreme, but gold, I think, is better positioned near term. But both of them I still see going meaningfully higher because of uncertainty and excess fiscal and monetary policy.
So before I go into this real quick, I just want to tell you that on Kalshi, 56% Kevin Walsh, 27% probability Rick Reeder, and 10% probability Christopher Waller. I really thought when this talk first started that Waller would have a better chance.
Don't you think that this means, though, the fact that he's dragging his feet means that he's not happy with any of these candidates? Does that make sense to you?
It does. And that is actually a very interesting point. He may not be getting the level of promised sort of loyalty, something that he loves to look for in the people he appoints from any of these people. And there's a good reason for that, because on the other side of it, you know that if the Fed just does whatever the president wants them to do, that's going to roil markets. That's not a good thing. You need at least the illusion of independence.
Well said. That's one of the takeaways from this episode is you need the illusion, at least, of independence. Okay, let's talk about yesterday for a second, because I think something happened yesterday that was extremely telling. Okay, the stock market got absolutely shellacked. At the same time, so did bonds, not just U.S. 10 years, but Japan. So the thesis is this, is that, again, if Japan is collapsing in real time with their 30-year, or maybe it's their 30-year went from 2% to 3.82 in about 10 months' time. It is, to call it a crisis might be slightly exaggerating, but not much. They have a crap ton of bonds to the tune of about, maybe there's 1.5 trillion U.S. long end bonds that the Japanese have. Does that sound right? That's the research said today. I thought it'd be more than that. But anyway, so the point is that if we have $11 trillion we have to finance $9 trillion of the debt wall that we have to sell those bonds for in 2026, plus the extra $2 trillion to finance our deficit if it stays the same at $2 trillion. So we have $11 trillion worth of bonds that we need to sell this year. If Japan's going to join in the selling, what happens to our 10-year yields? Do they go to 5%? And what's the magic level where the Fed starts buying them with both hands again?
So I would say on the one hand of this, demanding a higher term premium makes a lot of sense everywhere. Where are you going to see currencies worth the same in 10 years from now? Where are you going to want to lend governments who are all being fiscally irresponsible to different degrees that money for that term? So I think that suggests that, between 2s and 10s, you still got more room for that bear steepener to drive the 10-year yield. I'm looking for 4.8% near term. I think the breakdown in the 10-year futures suggests the same, that we could get basically back to where we were around April of last year in the yields, which was kind of like a vote of diminishing confidence. I'm not going to say no confidence. If we push meaningfully above 5, that's what it's saying. No confidence. The velocity of the move is very important. The fact that this is happening quickly, you've got over $100 trillion of global debt that keys off 10-year rates, including things like mortgages. The faster it moves, the harder it is to hedge moves like this. And you just get liquidity drying up. You get forced selling of assets, and you get monetary and lending conditions overall kind of tightening on their own. So to your point, when does it compel the Fed to come back to the bid? Remember, for a long time, from the great financial crisis into COVID, the Fed was one of the largest buyers of treasuries at auctions. There were a few periods where they stepped back, yields would go up. We've seen that happen again. They're already doing their sort of not QE on the short end. So they've shown their willingness to step in. I think that if we get beyond the 5% on the 10-year, if we see that kind of yield, they're more likely to start talking about things like yield curve control again, which, by the way, was something they discussed during the great financial crisis. That was among the things that were recently brought to the public.
Yeah, and by the way, I'm going to give the question to Bobby, but I actually think it's a little earlier. I would guess 4.8%. The mumbling starts about maybe the Fed jumps back in, and then they do it just above there. Bob?
This seems to me a little bit to be, I think we've had yield curve control already. I mean, it's been loose. You know, we haven't had the target yields and all that, but that's essentially what QE is for the most part, right? It's trying to control yields, trying to print money and control yields at the same time. Am I wrong to assume that?
No, that's exactly right. Yeah.
Seems like a distinction without a difference to me.
Right.
I would say it was the big impetus was exactly what Bernanke tried to deny to Congress and ended up lying about, which is that, you know, he said, we're not monetizing the debt. They are absolutely monetizing the debt.
There's no other way to look at it.
Yeah. He told us they were gonna, and then he did it. He told us how they were gonna do it, and then they did it. Well, the people that don't, it's crazy. But anyway, I'm sorry. That was my little rant.
All right. So real quick, I just want to read something that I read to our guest yesterday, Will Rind. For more than a decade, this was sent to me by a friend, Mayhem, and he's in the markets like us. And he wrote, for more than a decade, U.S. non-monetary gold exports ran at roughly 1 to 3 billion per month. That regime ended in late 2024. By October 2025, exports exploded to 17 billion in a single month, an order of magnitude shift. This is not volatility, seasonality, or jewelry demand. Non-monetary means physical bars changing custody, not central bank bookkeeping or swaps. When gold leaves this way, it isn't chasing yield, it's chasing control. The destination matters. Nearly all of that October flow surged to Switzerland. I confirmed, talked to Dana Samuelson today from American Gold Exchange, where Jim and I do all our gold dealings. And he confirmed that if it's going to Switzerland, it's going to Asia.
Yeah.
Right? It's going to the Middle East and Asia.
Well, it's leaving our country, Bobby? Okay.
Leaving our country. And that's why he says when gold leaves
yeah.
this way, it isn't chasing yield, it's
Right.
chasing control. Mayhem, reading that, you could disagree with the conclusion, but the $17 billion export number in October of last year is factual. Do you think that's about control, number one? And number two, does that make you want to hold gold more or just as much?
I love the point that he's making. It's a very important point. And I would say that from my own point of view, something big changed when the response function from the West to Russia's invasion of Ukraine was to further weaponize our dollar and our financial system. As a result, the bid for gold from central banks and governments around the world surged and never looked back. It's been unrelenting. This is part of that. And whether it's, you know, de-dollarization or kind of undermining some of the foundational underpinnings of Western hegemony, you can look at it from a number of different dimensions. It all says the same sort of thing, though. The world is starting to lose confidence in the U.S. more and more, and also becoming more nervous about how we're weaponizing institutions that used to be more neutral. Using your currency as a weapon makes people want to use it less, makes people want to buy assets denominated in it less. And what are you going to buy? Certainly not going to buy euros. You're not going to buy yen. You're going to buy gold.
And the ideologues who think, well, we had to have sanctions on Russia, we had to do this. Well, if you're the world's arbiter of trade and the steward of the reserve currency, you have a responsibility to stay somewhat impartial. If you don't, there are ripple effects. It's Thomas Sowell. There are no solutions.
I was just going to say, Jimmy, it's like the perfect example of unintended consequences.
Exactly. Yeah. Where all people
you combine that with the truckers in Canada.
Yeah. Exactly.
And who the hell would want to? Anyway, I don't want to say that part, but
nope. Okay, so let's go back to Japan for a second.
Yeah.
Do you think that we are seeing in real time what happens when you just profligate spend? Structural problems, is that thing going to implode, and what will the ramifications be on our shores, Mayhem?
I will say that there is not a happy ending in sight for Japan. The demographics from an age perspective are abysmal. Yeah, I mean, you've got a huge amount of aging folks, you've got minimal working folks. No one wants to have a family because the economy has been a challenge. And, you know, so like, who's going to buy that future debt? Those 10s, those 20s, those 30s, there's really no one there to line up. And a lot of Japanese debt is held by people in the country. Well, those people aren't being born to buy that debt. So, you've got 250% debt to GDP. You've got the central bank owning 51% of the debt. You've got the government of Japan owning 50% of the central bank. It's like an Ouroboros feeding on itself. And the end result is that now the debt's becoming less and less appetizing. But before that, the yen was also depreciating markedly. Those are two trends that I think can continue, but most particular, the yen. It is something you pretty much just have to sell strength in constantly now and pretty much forevermore unless the demographics improve in that country.
Yeah, and the yen's down 35% in the last 3 years against the dollar. And here's the spoiler: the dollar's shit as well. So if you're
Right.
down 35% against the dollar, that's a pretty bad thing. So my belief is that if yields in Japan start to go even higher, then the BOJ is going to come in and start buying that debt, which is going to hurt the yen even more. So it's like pick your way of death. It's either firing squad or hanging, correct?
It is, and if you look at from the perspective of a metaphor for people that are watching or listening that may not be as familiar with the intricacies. If you walked into a neighborhood, there'd be three houses: the U.S., the European Union, and Japan. The house that is Japan is burnt to the ground, it's just cinder and ash. The house that's Euro is on fire. And it's in dire straits. And the house that's the United States, it's still in trouble. It's got termites, it needs new flooring, etc. But all the houses are terrible. And it's a race to the bottom in global currencies, which is why precious metals are bid. Also, you can track Japanese 10-year yields, plot them against the price of gold over the last couple of years. They track each other. Gold continuing to benefit from global uncertainty, whether it's long ends blowing out or Western hegemony being undermined or increasing tensions or whatever the case may be. Gold loves this type of environment. So I think we do have room for long end yields to continue pushing higher. Nothing's fixed that. And as a result, and other uncertainty catalysts are in this mix as well, we still have room for precious metals to move higher. I think gold 6,000, by the end of this year, if not higher, is very modest.
Right. And I by the way, the quote that I can't figure out who made it up, so I'm pretending I made it up, which is regarding investing is Europe is a museum, Japan is an old folks home, and China is a prison. Based on those descriptions, you'd invest in the US. Now, if you don't want to invest in the US and you can't invest in any of those three, what do you buy? You buy gold. But anyway, before we move on to the second half of the show, Luis, can you put the banner up? And now is the time of the show where I ask a favor of our viewers. If you guys could do us a huge favor and try Tradier Pro options trading platform for 3 months for free. We talked to options traders who've been doing it for decades, who've been doing it for days, and they all say the same thing, is that this is the top of the line. This is the gold standard of options trading platforms. Scan that, try it for free for 3 months. There's absolutely no obligation. If you're not even interested in doing it and using it ever, just do it as a favor to us. I would appreciate it. And now back to the show. Bobby.
I want to put up another Widge comment and get your comments on it. Mayhem. Widge said, where was it? Luis, you got it for me? Because I can't find it in the comments. There it is. I continue to believe that we're seeing the inverse of the 2005 situation. Trade deficits aren't coming back, and monetary policy is already starting at inflation that is too high. Staring, I'm sorry, at inflation that is too high. What do you think about that comment?
I do think that we are living in very unique times. Like, I know people love to look for analogs and say, oh, but if we just look at this chart from 1963 and compare it against I think this is one of those times where we can't really go back and look for an analog. There's nothing that looks like what we're going through today. And I 100% agree with the point that monetary policy is already, if you're looking forward, and as Powell started to talk about during the more recent Fed commentary that he's given, you can't really say that the risk of inflation coming back is over. It's not out of control by any stretch. We're not even close to that point. But to say, hey, this is a great time to cut by 100 bips, I don't think that's the best choice here. Unemployment is still within historical lows. And on the other side of it, inflation is still beyond where the Fed wants to see it. So if you look at their supposed dual mandate, there's no real reason to ease here. Of course, there's other reasons outside of their dual mandate, one of them being yields, the other one being short-term liquidity.
Right. Well, also, if we're hitting the wall of debt, we want to be able to refinance that at lower rates. I'm sure they would love, well, the president I know would love lower rates for that. Do you think that comes into the equation at all too, just facilitating the government's borrowing?
I think it has come into the equation for years now. I mean, look at the Treasury borrowing much more on the short end. Look at the Fed now being much more active on the short end. I think there is a back and forth relationship. I think under Biden, Yellen did everything she could to pull as much of that debt issuance into the short end. And so now we're kind of trapped with that. We've got to deal with that. The Fed's sort of now coming back in and directly monetizing tranches of that on the short end. And now we're talking about, well, we've got all this other debt to refinance. Wouldn't this be a good time to pull rates lower? Of course, in order to do that with any credibility, you do have to have a bit of an unraveling. And it's very easy to get there if you imagine the generative AI growth story starts to fumble a little bit, which could certainly happen. There is a PricewaterhouseCoopers story saying that over half of CEOs investing in AI still aren't seeing any return. And then on the other side of it, if the fiscal side gets in any way depressed, that's such a big peg of U.S. economic support. And then finally, there's three pegs on this sort of stool that keeps the economy growing. It's the affluent spending, the top quintile. And if they slow down because wealth effects in the market slow down because the Gen AI story starts to come unraveled, that all does what? It helps to bring down asset prices. It helps to boost demand for bonds, for safe haven assets as they're perceived. So I'm not saying that's what's going to happen, but that's the dream scenario. If you want to refinance debt at lower rates, you've got to have a slowdown. You've got to have diminished risk appetite, and you've got to have some of these narratives like in AI kind of come unraveled for a little bit.
That's okay. So the AI narrative, let's talk about that real quick. What are the chances that the Federal Reserve under Jay Powell right now is looking at job stagnation and thinks, rightly or wrongly so, that part of the job stagnation is because of AI, and not necessarily that AI is making these companies more productive with less headcount, but more importantly, making these companies think they're going to be more productive with less headcount, which at some point in time they might realize they're wrong. But anyway, so let's look at that. If the weakness in the labor market that we're seeing, and as you just pointed out, it's not that weak. It's just we're not creating a crap ton of jobs. If they are easing to address that as part of their dual mandate, knowing full well that there are parts of the economy that are expanding and not exactly red hot, but definitely above room temperature. Isn't that the perfect scenario for risk assets, hard assets, everything, if they're easing into a good economy?
Yeah, easing, it's sort of like the idea, run it hot. We've heard it from Besant. If the Fed helps the fiscal side, which is already running it hot, if they add in with monetary policy, that's the perfect storm for asset inflation and real world inflation, which nails the two scenarios. You're talking about stocks. You're also talking about gold, silver, possibly oil eventually catches a bid. But yeah, 100%. That's exactly what you want to see. And just to quickly illustrate the magnitude of irresponsibility on the fiscal side that transcends two administrations now, this is the highest level of deficit spending with unemployment near these historical lows that we've ever seen. The government is playing a really big role in the economy as kingmaker.
So what do you think? And this is going to be to you too, Bobby. If you look at the next 3 years, let's say next 4 years, whatever, what is the possibility that the bond market flexes its muscles and tells us that we have to get our act straight? Meaning, some sort of bond crisis, currency crisis. Is that a possibility in the next 3 or 4 years?
100%. I think it could be a possibility in the next 12 months.
Okay, Bobby, do you agree that that's because I thought 2026 would be the year we got things going. Trump got his deregulation, his tax cuts, and then they'd slow down spending. But right when a politician gets to that moment where they're about to slow down spending, they come to the realization they like all the money running through them. They want to keep spending. There's no way they look at Japan and say, okay, shit, we got to avoid that.
Well, I think, and I don't want to come across as trying to defend spending because I'm not. I'm freaking pissed off about it, to be honest. But I think Trump truly believes that he needs to win the midterms. And so I don't think he wants to cut too much. Cutting the government jobs, I think he feels like he can talk his way through it. But turning the economy into a quick recession that we quickly climb out of, I think there's too much risk for him on the political side, because if we end up with a Democratic Congress, everything grinds to a halt. I mean, he's already got he changed the name of the big, beautiful bill, but I don't remember what he changed it to. I don't really care.
I don't listen. Right.
But we talked about, yeah. And then, Stephen just put in here, Trump loses the midterms, impeachment after impeachment.
I agree with you,
that's
Stephen.
a fantastic point. And I think that's why he doesn't want to cut spending as much as like at least the two of us, Mayhem, I don't want to speak for you, but it
You can
sounds like
speak for me.
on
I'm
that.
not a fan.
Yeah, I mean, it's like we wanted spending to stop for a long fucking time. Slow it down, because otherwise you're Bitcoin and gold and nothing else. Which brings me to my next question for you. So I spoke at a Bitcoin conference, and I want to target the question and then get your overall opinion on Bitcoin or crypto in general. I said the same thing I did when I spoke at the previous Bitcoin conference. My two problems with Bitcoin, as somebody who doesn't fully understand it, admittedly, right? And somebody who's involved in traditional finance for 30 years. I don't like that the Bitcoin community thinks there is no way that they're wrong, that it is the only solution, and there's no other solution, number one. I'll stop right there and I'll go to my next one. What do you think of that thought, just as I said it?
One thing first, I just want to say to respond what you were saying earlier, which is that there's not the appetite to slow. I 100% agree. I think we got a preview of that last year where, things were starting to creep into, hey, maybe this will cause a recession. And all of a sudden there was this big U-turn from let's slow things down to let's run it hotter. Let's run it hotter than inflation, outgrow the inflation. So I think you're dead on with that. In terms of Bitcoin, I will be very candid. My opinion has not wavered that it is a relief valve for excess speculative liquidity. It's always been that. It doesn't work very well as a transaction system. It doesn't work very well as a hedge against geopolitical uncertainty or inflation. It's really just there for people that have very high risk appetites and extra money to park something into. Can it help with debasement trends long term? Probably. Is gold maybe going to be better than that? And maybe that's part of the rotation we've seen over the last several months? I'm thinking so.
Well, you can actually see the flows move from gold, I should say, into gold and out of Bitcoin. Doesn't mean it's one for one. Doesn't mean the flows have gone straight from Bitcoin into gold, but it happened at very similar times, very similar stretches. And the second thing that I said to them is, why do you call this a safety asset when it's still tightly correlated to the NASDAQ, as we're seeing today again?
Yeah.
Right. Especially to the downside. If the NASDAQ drops, Bitcoin's drops. If the NASDAQ goes up, Bitcoin doesn't always go up. And the third thing I said to them was, if it's a safety asset, why are you all so concerned with where the price is today?
Yeah.
And they all claim to me they're not. Right. So maybe the people at this particular conference were not. Maybe they see it differently than the vast majority of who you see on social media. And that was really what they said to me. So Remo's got something up here, Luis. Bitcoin believers, never put all of your eggs in one basket. I think that's advice for him. And I think that's really what I was trying to get across to everybody. It's like, anytime someone comes to me with this can't be wrong, I'll tell you a quick story about principal guaranteed bonds that were backed by Lehman. Somebody wanted me to sell those, Jimmy, back in the day. Yeah, he's like, you want to sell these? It's great. Principal guaranteed. Well, by who? By Lehman. Well, but that's not good. Well, they could never go out of business. 3 years later, they were out of business. I bumped into somebody recently who had bought those. Anyway, so anytime someone comes to me with this can't, what?
They bought them from you?
No, I declined selling them because I didn't like the approach. Good. But does any of that ring crazy to either one of you, what I just said?
No, actually quite the opposite. I think it's very grounded. How would you say this is a safe asset, which, by the way, that's what stable coins are supposed to be, for buying something to preserve, some sort of tangible relationship with something else. A stable coin in the crypto ecosystem is more that than something like Bitcoin, at least in my humble opinion, for all the reasons you mentioned, like when there's risk off, it goes risk off. And we're talking about geopolitical tensions inflaming. This was supposed to be a safe haven, and yet it sells down. Or, you get other kinds of things like liquidity dries up in bank reserves and reverse repo. And you can see that excess speculative liquidity barometer coming down, that Bitcoin price coming down with it. It's not a safe haven if it doesn't behave like a safe haven.
And that happened yesterday, right? I mean, it happened yesterday. Bitcoin dropped, I think, 4.5%.
Meaningfully.
At the same time that gold was rallying like 3.7%.
Yeah. And as soon as those headlines of geopolitical risk escalation happened over the weekend, crypto, the entire complex was selling off.
Yeah. And again, I don't want to take a big victory lap, but Bobby, you and I, we've been talking about this on this show for forever. Bitcoin,
Yeah.
I own Bitcoin and I own Ethereum, Solana, and Ripple too, but it was mostly just a game. It was mostly just putting my chips on that one odd box that never normally comes up, meaning if you guys are all right, I don't want to be left on the sidelines, but I don't think you are right. So it's, it's an asymmetrical sort of wager that I plan on losing my money. Ma'am, do you own any Bitcoin?
I have a very small allocation to Ethereum that I've been opportunistically allocating. I don't have any Bitcoin. I trade it. I trade all these things as beta vehicles. And really, I will say, Bitcoin and Bollinger Band squeeze breakouts, great way to backtest and systematically trade this thing. You don't have to have any kind of opinion or emotion, whatever it is. You just trade the signals, and it tends to do quite well because it's a pure psychology, pure momentum instrument.
Right. There's no real fundamentals, right?
Yes, a lot like gold in that way, which is also why gold trades really well with Bollinger Band squeeze breakouts.
Fascinating. Okay, so let's look at like going further in 2026. Yesterday I was on a show and I was saying one of the perfect storm for stocks yesterday, and again, it was a one-day thing, is that we are in some ways priced for perfection. I know the NASDAQ has traded sideways since putting in the highs in November, but it's still at relatively stretched valuations. I think both those stories that hit yesterday, which was we're bombing Denmark or whatever the hell it is, it's a joke, and that Japan Japan is burning to the ground. Both those stories were real and reasonable, but stocks are kind of high. Stocks might be prone for a little bit of downside. Anyway, once we work out the downside, whether it be sideways or through a correction, do you think 2026 looks good for stocks? And do you think it's better for Russell? Mayhem first.
I do like the Russell here more. I think that it's been the sort of underdog, but there's also these macro tailwinds for it. Rate cuts are great for risk appetites. They're great for small caps refinancing their debt. This is going to be better, I think, for the S&P 600. So if I want to buy small caps, I want to buy the S&P 600 over the Russell 2000 personally, just because I think the fundamentals are stronger there. The S&P 600 trading at a PE of 15.
But there's one thing I'm trying to get you to say that you haven't said yet. Do you think that the domestic economic story is going to be good, positive, tailwinds in 2026 with deregulation, tax cuts, all this stuff coming down the pipe? Is that one of the reasons for the Russell because it's a strictly domestic story?
I think that's a fair point. There's no reason that couldn't be a catalyst for these companies. I think the biggest economic headwind is actually the potential of the generative AI story unraveling. And if that does happen, that should also actually be a situation where at least the Russell can outperform. Doesn't mean it's going up, but it can outperform the NASDAQ in that scenario.
That's something we talk about all the time, is that, losing less is still outperforming.
Yep.
Yeah.
Like you hear that crap all the time. So that kind of brings me to the other thing I wanted to talk about. Our partner in our newsletter, Mike Arnold, put Jim and him write a piece at the beginning of the newsletter, and then it goes into his technical analysis. And then I pick stocks and Mike and I analyze them. And we put out recommendations, right? Trade recommendations. And they're basically medium term, right? 30-day hold kinds of things. And in those newsletters, Mike wrote a while back.
Oh, by the way, I will add that Bobby and Mike are 78% hit rate over the last year. 78% hit rate. He might not want to boast about it, but I will. Bobby, go.
Yeah. Thanks, Jimmy. But basically what Mike said at the end of the year, I don't remember if it was last issue it did January or last issue December, first issue of January, that we were likely going to shy away, at least for the first quarter, possibly the first two, from Mag 7 AI type trades. And we would be going into more normal, consumer defensive, things like that, consumer discretionary stocks like that, energy to a certain degree, financial, and get away from tech for a little bit on these trades. And the first couple of trades we did, which have worked, were Ingersoll Rand and Scott's Miracle-Gro. And the funny thing about it was the Scott's Miracle-Gro really caused an uproar because a bunch of people were like, what, why are we trading grass feed? And all, and of course it went to all three targets right afterwards. Do you think that thesis of kind of like pulling away from AI in the short term to watch how a lot of this stuff plays out, tariffs or anything else, and then possibly maybe taking the second wave up, is it that much overdone? Do you agree with that idea?
Yeah, I do. I think I love the Scott's Miracle Grow idea, by the way. And the fact you got that pushback is so validating for a contrarian like me in plays like this. It's like, oh, you hate it? I love it even more. Thank you so much. But no, I think that's exactly what we need to focus on, because these AI names have run on this circular investment theme, and we're seeing cracks in the surface. We're seeing cracks at OpenAI. Why is this company going to run ads? They didn't want to run ads. Even Sam Altman described this as their last resort. Why are they going into erotic AI chat? I mean, really? We were supposed to have PhD level AI. Now it's going to be porn level AI? What happened? Why are we trying to monetize AI video slop? This was supposed to be a company that changed how we did business. It was supposed to change how we did scientific discovery. And it feels like they're going sideways. Meanwhile, Google is absolutely nailing it. Their models are leading the pack. They're using their own hardware to do it. You look at companies like Anthropic, say what you will about their politics, it leaves something to be desired, but their models are next generation. And then look at what's coming out of some of the labs, the open weight models you can run on your own computers. All of this is competition to OpenAI. They had first mover advantage, but they're not innovating. And if I might color it with my own opinion here, I don't think Altman's a great CEO either. So I think if we start to see that narrative unravel, which I think it kind of already is. Look at the NeoCloud stocks, for example. If this thing was full speed ahead, they too would be rallying higher. Instead, they've come off quite a bit. And you look at the way the mega caps have handled this, they've started to kind of shelter their risk in the space. So Microsoft, instead of building their own compute capacity, is investing in companies that are. So that at any point they could say, you know what, that's not working out. We can write that off in a way that's much less harmful to our investors and our balance sheet. You see that kind of de-risking elsewhere as well. You also see new entrants. I mean, Google, their TPU is 70% cheaper, more power efficient. That's very disruptive to the status quo and the sort of NVIDIA pick and shovel GPU race that we've been running. It's a lot like the gold rush.
Mayhem, you know why Google's my single largest position and has been for about 7 years?
Because it's built into everything.
No, but that's part of it, because it's the CIA.
Yeah, in QTEL.
Yes, exactly.
Yeah.
It is the most asinine thing when people used to push back on me 6 or 7 years ago, and I'd be like, you think the CIA, the world's largest intelligence agency, is going to let somebody else collect intel on people way, way better than they do? That is preposterous. When people used to push back, I'd say, oh, I'm the conspiracy theorist. What you're saying is ridiculous. Anyway, I want to finish off. Oh, by the way, you said something about pornography and OpenAI, which if you look at the history of information technology, the thing that amazes me the most is probably one of the single biggest drivers. I'm saying like VHS over beta. And you know that I'm right? The internet in general.
Internet traffic.
Yeah, porn has been one of the huge drivers of information technology. And people try to pretend that that doesn't exist. It does. Bobby, I'd love to finish off with an oil wrap up to you. Are you ready to talk about oil too? And there's a reason I want to, is because
I can, but can I put up Remo's nat gas question? Where you just said nat gas thoughts.
How about it?
And I assume he means the last couple of days.
Freezing my ass off, Remo. That's what I know.
Yeah, I assume he meant the last couple of days. Mayhem, I don't know if you follow this at all, but before we got this surprise cold snap, which is stretching out now, you had supplies 123 billion cubic feet less than this time last year. Yes. They were still within the 5-year average, but way toward the bottom in terms of stocks. So that's a big part of why we're getting this big jump. This was a surprise cold snap in terms of the depth of it, the duration of it, the brutality of it, and how far it went. We had 41-degree weather in Southwest Florida. You saw people in parkas with hats on, snow shovels in Southwest Florida. It was nuts. So, I mean, that's my thought on it. It's going to unwind, but now you have to rebuild stocks, Remo. So that's part of the problem as to when it's going to unwind. That's why I didn't trade this at all.
No, it was too big a move. I didn't trade it at all either. But I do. One of my big contrarian plays for 2026 is going to be crude oil, but it hasn't. Technically, it's done nothing for me yet. So, Bobby, before I get Mayhem's view on crude, can you look at a longer term chart and say where do I need a settlement before I can say, okay, the rest of the year might be positive? Maybe even it's on the monthly chart.
Right now, about 63.50.
So a settle above 63.50.
Yeah. That's the start. Okay, that's just to say I got a chance here. Right after that, you're looking above $76 because the downtrend has been so precipitous. You look at the 200 days at about 62.50. The 50 week is 63.25. So that's a fulcrum, and that could take us up into the 70s from a technical perspective. But there's no bullish calls yet on these charts. Maybe some short-term scalps to the upside, but everything is still substantially pointing lower. So for me, if it got to about 60, I don't know, $61, I'd probably take a short.
Interesting. So, ma'am, the reason I'm liking crude more, and again, if the technicals don't back up the thesis, I will not trade it. There's no question about it. But the reason I'm looking at it so closely is we've talked about, and I do believe that the domestic economy might be poised to run at 5%. Atlanta Fed GDP now is 5.3%. We're expecting 4.3 on Friday. If we are running a relatively hot economy here, it would stand to reason that crude might catch a bid. Do you like the thesis?
I like the thesis if we can get the data and the momentum. So I like the thesis. We need to qualify it with the macro data. And one thing that's been an overhang in crude is global supply. Right. So we need to see that demand come back. If we do, the cure for these low prices will in fact be these low prices. Ultimately, I think that's a second half of the year story. And I'm with you on that. Like we could see probably oil trading in the 60s to 70s in the second half of this year, maybe even make a push up to the 80s if we get some decent economic data. I think on the other side of it, though, we're seeing something very interesting in the energy services companies. They're showing impressive relative strength versus the price of oil. While oil's been in like a prolific, almost 4-year downtrend now. Look at Schlumberger breaking out. Look at Halliburton breaking out. Look at OIH, the ETF. There's something going on here. And I think this is the play. And I'm a big believer of relative strength. So when I look at something like an oil stock versus its benchmark, or I look at an oil ETF versus the S&P, and I see them relative strength just continuing to build for months and months, I can't ignore that. One of the things we've been talking about at TraderAid is opportunistically buying things like Schlumberger and Halliburton and OIH as they're breaking out of some of these ranges. Those have been excellent trades. I still think there's a lot of room higher there.
Bobby,
even if oil doesn't perform.
Real quick, I want to ask about, actually, Steve just said it's 35 here in Tampa today, which I think was something I wanted to point out. Tampa's actually
the new dog I got, Bobby, when it was -5 degrees over the weekend, she looked at me like it was totally my fault. It was like, why did you do this? I felt so guilty. But anyway.
I wanted to throw in Remo's question because this is the second time he's put it up, and then that'll be the last thing I want to ask. Remo said transports are breaking out too. Remo likes transports. Mayhem, anything on that?
Yeah, I think that's an area to look at as well. And it would go with Jim's thesis that the economy starts to grow. You're going to need to move some more goods around the country. If we see some more certainty about prices, which I think we're finally going to get maybe a little bit more of an idea that we're going to cool these tensions on a more durable basis, that maybe people can be confident about buying some of the things they've been putting off for a bit, that would also drive that narrative, that you're going to have more real world goods consumption. And, hey, maybe, just maybe, if they're able to continue to push on Fannie and Freddie, you could stimulate some housing activity. And we know that's the biggest catalyst for goods purchases in this country. So if those types of things come online, transports are bullish. Sorry, Bobby, go ahead.
No, it's okay. I didn't mean to interrupt you. So I've remembered what I wanted to say to you guys. I want both your opinions, and I'll listen for your answers, as they say on sports radio. I'll hang up and listen for your answer. Today, Trump mentioned something that I forgot about, the 100% amortization deduction on new plants, right? They could write the whole plant off in the first year, as opposed to over, I forgot the word that describes that. Boy, my Alzheimer's is thick today. Yeah, they could essentially write a company or a plant or large
deduction.
What's that?
Deduct it in full.
Yeah, and all depreciate it, not just plants, right?
Depreciate it. Yes, okay. That's it.
Depreciate, bingo, right?
Depreciate it in a year, as opposed to what used to be like 25 to 30 years.
Yes.
When you combine that with something like no tax on tips and no tax on overtime for consumers, consumers generally in the middle class, that applies to. Do you guys think that'll have any sort of a surprise effect, especially the CapEx side?
I think the CapEx side is huge. I mean, you can anything that you were saying, well, we can't really do that because of X, Y, and Z. We've got to budget it, do it over a longer time frame, whatever. At this point, you've got a strong motivation because you don't know what the political landscape looks like moving forward to pull forward some of those investments. So I think for CapEx, that's bullish. And for some of the companies that are upstream from that are going to be providing, hardware to companies, providing office equipment and otherwise, that's great. In fact, I'll go out on a limb and say that's one reason we are starting to see shortages in memory, in flash storage, and in other areas of the hardware economy is because now you can just pull forward those purchases. So there's no reason not to. RAM is now booked out through 2028 in Korea. Imagine that. Completely booked out.
Are you speaking English right now, ma'am?
Yeah, like you can't buy memory. You literally can't buy memory.
I'm totally joking. I get the basic gist of what you're saying.
It's crazy, though. We've never seen anything quite like this. And if it actually is durable, what are you going to do? You've got to buy as soon as you can, whatever's not nailed down or on fire.
So this, like I said, Bobby, I really believe the economic backdrop is poised for serious tailwinds for 2026, which, by the way, does not necessarily mean the stock market goes gangbusters. They're related, but they're like cousins, not twins. So yeah, I think this could be a really good thing. And the no tax on tips, the no tax on overtime, mostly that's a political ploy to get all those votes, and it's a brilliant one. And then it opens the door for those substantial ones like the level of depreciating assets, which I think is amazing. Anything else you want to add real quick before we go, ma'am? Because we got to
tying it all together. I like the what's happening on CapEx as another bullish tailwind for the small caps. Because I think that many of those are going to be selling into that more than they would otherwise. And you've got the rate of financing these things coming down with a Fed rate cut cycle that's already brought us down over 100 bips from the highs.
Love it, love it, love it. Thank you so much for being here. You guys all know where to find them. It's Mayhem, at Mayhem and Markets on Twitter. That's what it is, right?
Yep, at Mayhem for Markets.
Mayhem for Markets. Oh, there it is. Yeah, Mayhem for Markets. Right. Yeah, follow him on Twitter. He's a great. You know what I like most about him? There have been times in our history you probably don't even remember. I'll say something and you'll say, no, you're wrong. And we'll discuss it back and forth, and not like the normal Twitter vitriol. It's just a good discussion. I like that a lot, and I appreciate it. I want to thank you for that.
I have a great deal of respect for you for the same reason, Jim. And you, Bobby, as well. We don't always have to agree, but we'll always be civil.
Love it. Bobby, do you want to say anything nice about Mayhem and I right now, or do you want us to just cut it?
Not at all.
No, I don't. This has been Trader Year's The Trader's Edge. Thank you to Trader Year for hosting us. Please join us at unfilteredinvestor.com. I'm Jim Iuorio. That's Bobby Iaccino. That's Mayhem, Markets and Mayhem.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.